Good morning, student. Topic we're going to start today: incomplete records. Incomplete, incomplete records, also known as single entry. Okay. Topic we're going to start: incomplete record and single entry. Okay. In this video, I'll give you the steps of single entry. The chapter is not difficult, but they require you thorough knowledge of accounting to calculate the missing information, right? So in this video, I will teach you the steps of single entry. Okay, steps. Steps. Okay, the first step in this chapter, what you have to do in this chapter, you will be given the some detailed information or some kind of information which is not complete, right? You are required to calculate the missing information and prepare the income statement and the balance sheet. The main objective of this topic is to prepare the financial statement with the incomplete information. Which is incomplete means? Incomplete means the information is not completely given to you, and how will you calculate that information? How will you find that before you start the income statement? This is the main purpose of this video. The first step to calculate sales. The first step to step number 1 to calculate sales. When you will calculate sales, we know that sales are on credit and sales will be in cash also. To calculate the credit sales, you have to make a SLCA, sale as a control account. With the help of sale as a control account, you can calculate the credit sales, and we know that balance BD comes on this side, and the credit sales which we will have to find, and the collection from account receivable come on this side, and the balance CD. Okay, when you add all this add all this credit side minusing this, you can find the credit sales from the SLCA. A lot of information could also be possible here: the bad debts, sales return, and set off. The all account sales control account information you should have to know in this chapter. So credit sale will be recorded here. And to calculate cash sales, you have to make a cash account. Okay. Important part of the chapter, examiner usually give you data which is quite confusing to calculate cash sales and cash and credit sales. This area need your full knowledge of accounting. So we know that opening balance of cash always come on the debit side. Okay, here we will calculate cash sales. How we will find this? We know that all cash payments come on the credit side of the cash account. For example, if there is any cash purchases, come on this side. If there is expenses paid by cash, come on this side. Okay, if there is cash drawings, also come on this side. Cash drawings. And if there is cash banked, that means cash has been deposited into the bank account, or if there is any closing balance of cash. Okay, this might be given to the examination. Cash purchase, credit side of cash account; cash expenses, credit side of cash account; cash drawings, credit side of cash account; cash banked. Cash bank means cash which has been deposited into the bank account. So this will come on the credit side of cash account and come on the debit side of bank account. So since we are making cash account, so this will come on the credit side of cash. And if there is any balance closing, CD closing and BD opening, we have to add this all minus opening balance. This will give you the cash sales from this information. Okay, add this all. Total of this minus opening balance of cash will give you cash sales. Okay, then with total sales which will be transferred to the income statement, total sales equals to credit sales plus cash sales, this all will go to the income. This total sales will be transferred to the income statement. The important part of calculating cash sales is cash account. Okay, the cash sales can also be calculated. The cash sales can also be calculated by alternate method. Okay, alternate method of calculating for cash sales. This method you can apply when you got the good concept of T account. Most of the students do not prefer to make a T account. They can try to calculate cash sales directly. So you can also solve it. Cash sales. You can also solve it. Cash sales equals to cash banked cash bank means cash which you have deposited into the bank account. Cash banked and plus all cash payments it could be payments for expenses, it could be payments to creditor, all cash payments will be add this, and plus cash balance closing plus cash balance closing balance CD minus cash balance opening. Okay, this will also give you cash sales, right? So you can either calculate cash sales from the T account. I will prefer T account. Okay, all up to you, but I will prefer T account. Normally I prefer to my student to draw a T account. This is the easiest method. Here you can easily apply the cash payments and all cash payments on the credit side and the balance BD on the debit side. Add all this minus this equals to cash sales. Or you can draw by this as well. This is itself a T account, but we have made T account in the horizontal format. Cash banked, all cash payment. This is all cash payments. I've added this. Closing balance of cash, I have added this, and opening balance of cash, I have minus this. Same thing you can do in the T account. Okay, so it's all up to you. You can draw either cash account or cash for calculating cash sales, or you can draw this format. Is all acceptable. Okay, cash sales can also be calculated by markup and margin. Okay, in this examination, in your examination, the cash sales, or in Cambridge examination, cash sales usually asked by the examiner by the help of markup and margin. Okay, let me give you an idea about calculating. I'm still explaining the calculation of sales. Well, this is the most important area. Normally, students got confused of how cash sales or cash credit sales will be calculated. Okay. For example, we know that sales is equals to cost of goods sold, COGS, plus gross profit. We know that, and the gross profit we know that gross profit is also equals to gross per markup or margin. Okay, so for let's say for example, if the opening inventory is $60,000, okay, and purchases during the year is $140,000. I'm just assuming that, and closing inventory for the year is $20,000, and the gross profit markup is 25% on cost. 25% on cost. Okay, class. Markup is the gross profit on cost of goods sold, and you are required to calculate sales during the year. Okay, When you will calculate sales with the help of markup and margin, sales can be also calculated by account receivable account, as we have discussed previously. And once you have markup and margin, then you can also calculate sales. So for that, first of all, what you have to do, you have to calculate COGS. COGS equals to opening inventory 60,000 plus purchase 140,000 and the minus closing inventory which equals to 20,000. So what will be your cost of goods sold? So what will be your cost of goods sold? Cost of goods sold equals to 180,000. Okay, 180,000 cost of goods sold, and we know that sales equals to cost of goods sold plus profit. Here the profit is given 25% markup, which is 25% on cost. So 180,000 multiplied by 25 upon 100. This is gross profit. Okay, sales is COGS plus gross profit equals to, this will give you a total sales revenue 225,000. Okay, once you have markup, then markup is applied on cost. So for that you have to calculate cost of goods sold and add markup into the cost will give you sales revenue. Okay, so this is similarly there is sometime margin will also give an examination. You can find with the help of margin you can calculate sales also. There are a lot of ways with which you can calculate sales. I'm just teaching you the important part or where normally got student confused, and for that part I'm going to show you video. Okay, other part you can solve it from the past paper. If any confusion, you are most welcome to ask me in any means of communication. Right now the second step is, this is all about sales calculation. Now second step to calculate purchases. Second step to calculate purchase. Step number 2 to calculate purchases. Similarly, to calculate purchases, we have to make PLCA to calculate credit purchase. Usually, cash purchases will be given to an examination, right? For calculating credit purchase, you have to make PLCA. Purchase is a control account. Opening balance of PLC come on the credit side, and the credit purchases, we know that credit purchases come on this side, which is not given. Payment to supplier. Payment to suppliers by check or by cash come on this side, and there are a lot of other things, discount received or purchase returned and set off, all the concept of PLCA. Usually in the single entity, examiner won't provide you the detailed information of control account. If examiner wish to check your concept of control account, the examiner will prepare a separate question for that. So I'm assuming balance CD of purchase is a control account total, and this by this equals timing balancing figure. Then by this you can calculate credit purchases. Add this to payment to supplier and the closing balance of PLCA or closing balance of supplier minus opening balance will give you credit purchase. For calculating purchase is not difficult in the single entity. Usually the concept and the problem arises in the calculation of sales. Now after this, step number three, after calculating sales and purchases, this is not enough requirement. We should know the expenses. Okay, for that you have to make an expenses account. Okay, in expenses account, we know that the prepaid expense come on this side, on debit side prepaid BD, and owing or accrued BD come on this side. Okay, expenses paid during the year come always on the debit side, right? Prepaid BD, owing BD and owing CD. Owing means accrued CD come on this side. Okay, prepaid BD come on this side, and the prepaid CD. This is not difficult, you all have learned in O levels. Prepaid CD come on this side. The difference will be transferred to the income statement. This thing we have to calculate. So what we have to do, add this all debit side, prepaid BD, expenses paid during the year, and owing CD, add them all, add them all, minus this will give you expenses transfer to the income statement. This you have to transfer to the income statement. Okay, this is an expense account. And number fourth, next step number four, calculation of depreciation. Okay, depreciation can also be calculated as per policy or whatever. Normally, depreciation can be calculated by straight line or by reducing balance method. This is you should have to know. Depreciation usually can also be calculated by difference of cost. Depreciation can also be calculated by opening balance of opening non-current asset plus bought minus closing non-current asset. If the method is not given, examiner is not identifying this method, you have to use either straight line or reducing balance. Then we have to apply the devaluation method. Opening non-current asset, book value, net book value of opening non-current asset bought for the year, and net book value of the closing non-current asset. The difference is known as depreciation. Otherwise, you can calculate depreciation as per the policy given. Now, step number 5. Now, in step number 5, stock lost. Okay, sometime examiner will ask you to calculate the stock or inventory lost. Okay, this is also known as inventory destroyed. Inventory destroyed. Destroyed inventory. There are a lot of ways the teacher can teach this, and which I have made that in a specific formula to calculate stock lost. The stock lost can be calculated. You better calculate stock loss by this formula: opening inventory plus bought. Okay, opening inventory plus bought. You can also write purchases, also known as purchases, minus closing inventory minus COGS. Okay, whenever examiner will ask you to calculate stock lost or stock destroyed, you always have to given either markup or margin in this question. Okay, I better explain this with one example. For example, I'm just making one question here. For example, inventory at 1st January 2017. 2017 is $18,000 of purchased during the year was $70,000. Okay, and inventory at December 31st 2017, which is called closing inventory, $5,000. Inventory closing is the $5,000, right? And sales during the year, $100,000. Sales is also known as revenue. Okay, so whenever inventory loss is required, then you will be always given sales. Okay, and you are required to calculate this. How examiner give the statement? Examiner will give a statement this way. There is some inventory which was lost at the end of the year, and inventory was only calculated in the warehouse or in godown, which was a cost of $5,000, and some inventory was lost which is not known. So you are required to calculate the cost of stock lost. You are required to calculate the cost of stock lost. Okay, and we have a margin is given 20% on sales, and margin, we know that margin is always be calculated on sales. So now we can solve by this question with this formula, opening inventory plus purchases minus closing inventory and minus cost of goods sold equals to stock loss. We have the opening inventory, we have purchases, we have closing inventory, but we do not have the cost of goods sold. How will we get the cost of goods sold? Now to solve this, I'm going to solve it. Solution. We know that COGS equals to sales minus gross profit. Okay. Sales revenue is 100,000. Gross profit is 20% of sales. Okay. 20% of sales, 20 upon 100, which is 20,000. So your cost of goods sold is $80,000. Okay. Now I'm going to calculate stock loss. Stock loss. Stock loss equals to the opening inventory, $18,000 plus purchases $70,000 and then minus closing inventory $5,000 and minus cost of goods sold $80,000. Okay. How? So if you add the, according to our record, inventory must be in the warehouse equals to this. Let me tell you, equals to 83,000. Equals to 83,000. Okay, minus 80,000. According to our record, when we add opening inventory with purchases and minus the closing inventory, okay. So according to our record, the cost of goods sold must be this will equals to cost of goods sold. According to our record, the cost of goods sold must be equal to 83,000. It is coming 80. Where is 3,000 gone? That 3,000 means the 3,000 has been lost for the year. The cost of closing inventory, which is 3,000, lost for the year. Okay, so that means the stock lost 3,000. That means stock lost is 3,000 for the year. This is, you have to calculate yourself. Stock loss 3,000 and this stock loss will be transferred to the income statement as an expense. Must know the double entry of stock lost. The double entry of stock lost is we always equals to the income statement debit and purchases credit. Plus this might come in MCQs. Okay, stock loss we will not minus from the closing inventory. Stock loss we will minus from purchases. Most of the past paper you can see examiner has minus it from the closing inventory, which I think is conceptually wrong. The market scheme is not always authentic. Whenever you have a stock loss, you have to minus from purchases and add as an expense in income statement as a loss. This is the calculation of stock loss. And the next step, this is step number 6, was calculation of stock loss. Now step number 6. Now step number 6, the calculation of opening capital for the balance sheet. Okay, there are some calculation for balance sheet. Okay, there are some calculation for balance sheet. Step number 6, the calculation of opening capital. Calculation of opening capital. As we know that the capital must be equals to always assets minus liability. What do we have to do? We can take all opening assets less all opening liabilities. Okay, this will give you the opening capital. This will give you the opening capital. Why this opening capital is important? Because opening capital, without the opening capital, you cannot start the finance by section of the balance sheet. We know that finance by section equals to opening capital plus profit less drawings. Okay, so this is step number 6. Step number 7. These steps I have made it for your convenience. It is not necessary that you always have to follow the same step. It's all up to you. You can solve it by working in the bracket in front of your answers. Sometime the profit can be also calculated by difference of capital. Okay, calculation of profit, that all depends on requirement. Calculation of profit by difference of capital. Difference of capital. Calculation of profit by the difference of capital. Okay. In finance by, when you will prepare a finance by, we know that opening capital plus profit plus extra capital less drawings equals to closing capital. Okay. So this is very common phenomena. This is very common phenomena, and we have learned it many times since your O levels. That when you will prepare a finance by, you can start finance by with the opening capital. We add the profit, and if there is any extra capital introduced by the owner, we will also have to add it, and the drawings will minus and equal to closing capital. What if the profit is not given and everything is given, and the profit you need to calculate? So with the help of this equation you can draw very easily. Therefore the net profit equals to closing capital. CC stand for closing capital, opening capital, OC opening capital. Okay. Yes, and minus EC extra capital, and plus D is equal to drawings equals to net profit net loss. When you move this all information on this side, applying the mathematical rule, this will become all minus. Okay, so CC closing capital. Okay, when you opening capital move here, it will be minus. When the extra capital move on this side, it will be minus, and drawing when we move on this side will be added. So profit or loss equals to closing capital minus opening capital minus extra capital add drawings. Okay, if the extra capital and drawings are not given, then the profit equals to opening and closing capital, because the closing capital is usually more than the opening. So by this way you can calculate profit also. Okay, and last step, sometime statement examiner can ask you about the statement of affairs. This is not coming in AS level, but as I'm always worried about the syllabus, it is very clearly mentioned in the syllabus that a student should have the thorough knowledge of O levels. So since the statement of affairs is coming in AS in O levels but not in AS, so I think the student have a little knowledge of statement of affairs. A statement of affairs is just like balance sheet. As you prepare the balance sheet, it's just like a balance sheet, and it is prepared to calculate. It is prepared to calculate capital in single entity system, and single entity system. The statement of affair is just like a balance sheet, and is prepared in single entity. In double entity we call it balance sheet or statement of financial position. Okay, it is prepared to calculate capital. So otherwise I'll give the notes of the statement of affair in the notes form. Okay, to read from there. This is all about the steps of single entry, right? This is all about the steps of single entry, and I will upload past papers questions in the Google Classroom. What you have to do, there are a lot of questions there. There are 18 questions, 1 to 18 questions. This is our last chapter of the syllabus. After this our syllabus will be finished. Okay, then after that I'll give you and I'll start MCQs after that. Okay, so you better try it yourself. I'll upload the basket schemes also, question of 1, 2. Okay, first 3 questions are very easier, and then rest of them the past paper question. You can try it. In case of any confusion, you're most welcome to ask me. Okay, this is all about single entity. Thank you very much.